Welcome back to FX Street. Certainly glad you could join us today. Today is Wednesday, the 24th of February, 2010. Welcome back, one and all. Great you could join us. My name is Rosen. I'm very happy you could join us today. Very special thanks to FX Street for hosting the webinar. We have a very fun topic, as always, to talk about today. This is one of the basics, but I think probably one of the easiest and I don't want to use the word reliable, one of the most consistent technical indicators that we can use. And we know this as the RSI, the Relative Strength Index. Now, you should see in front of you a chart. If you don't see the chart or my voice cuts out, please let me know. However, you should see a daily chart in front of you. We're going to start with the daily chart. The symbol is YM. YM is a future symbol for the Dow Jones Industrial Average. You can use the RSI on a number of different financial instruments, anything from stocks to foreign exchange and much, much more. Now, the RSI is the indicator at the bottom. What the RSI is, very simply, is it measures the relative strength, exactly as it's called, the relative strength of the market over the previous 14 periods on a scale of 0 to 100. I always use a standard setting. The setting is 14 periods back. If we look at a daily chart as we are, we count back 14 candlesticks. If we use a 4-hour chart, it would count back 14 4-hour candlesticks. I like to start with the daily charts, though, to get a good idea of the long-term trend and the RSI indication. Now, there's a couple different ways we can use the RSI. We can use it to look for reversals, and we can also use it to find breakouts and breakdowns. I'm going to show you both methods. If there's any particular currency pair, by the way, that you'd like to see, please don't hesitate, chat it in, and I'll be more than happy to jump right to that chart as well. However, without further ado, we'll get started. Now, again, the RSI measures the relative strength of the market on a scale of 0 to 100. Indications above 70 are considered to be very strong, meaning 70, 80, etc. Indications below 30 are considered to be very weak. Most of the time, you'll notice RSI stands between the 30 and 70 level. 50, obviously being the exact center, is probably the best indication of the average price of the market and the average indication of the RSI. Now, at times, the RSI will cross above 70 or below 30. When this occurs, we can look for let's first talk about reversals. We can look for reversals. As we see in the case over here, again, this is the Dow Jones Industrial Average chart, and we see at the very top of the Dow Jones Industrial Average, the futures hit highs of 10,673. That's on January 14th of this year. And the RSI crossed just barely above 70, so about 72, and then crossed below. Now, the sell signal occurs when the RSI does exactly this, when it crosses above and back below 70. We want to wait for the RSI to cross back below 70, and then we can look to sell short. When we sell short, we want to sell short as close as possible to the top, and we want to place our protective stops above the highest highs that the market was able to achieve, plus a little bit of breathing room. I'm going to explain exactly why. Now, notice how the market, again, we hit highs of 10,673 on January 14th. The RSI was just above 70 and then quickly shot back down. Then, a few days later, we hit 10,681. Actually, a few points higher in the futures. However, notice the difference in the RSI indication. As the Dow Jones Industrial Average actually made a few points of a higher high, the RSI was not above 70. In fact, we went down to about 65. This divergence, well, I gave it away, this difference or disagreement in the chart is exactly what you want to look for when we're looking for reversals. It's called divergence. Divergence, in other words, disagreement. The market makes a little bit of a higher high, but yet the RSI makes a lower high. Market makes a high of 10,673, a little bit of a higher high, 10,681. The RSI was at 72 and then went down to around 65. That disagreement shows us, well, for lack of better words, not everything is agreeing with our trade, and therefore the probability is of a reversal to the downside. Now, it's very important, and like we said before, we want to place our protective stops above the highs. The highest high is 10,673. Again, the market went up to a little bit of a higher high than that. We want to place our protective stops above those highs. Give yourself a good amount of breathing room. What's a good amount of breathing room? Well, it really does depend what financial instrument we're looking at and under what time frame. But you want to give yourself some room. So if the market does make a slightly higher high, our protective stops don't get triggered. If our protective stops were placed 1 point above, we would have been stopped out. However, 10 points above 20, we would not have. And we want to look for this divergence, RSI indicating lower high when the market makes a similar high, maybe even a little bit of a higher high, and then we look for a reversal down back to the downside. Where do we take profits? Well, we can take profits according to the charts. That's always a good idea. But as a general rule of thumb, if the RSI, or I should say when the RSI comes back down to around 50, that's a good spot to take profits. Why? Because on the scale of 0 to 100, 50 is the exact center. And the 50 line, if you think about it like a moving average, the market has the greatest probability to return back to the 50 level. So if we're going to sell short around 70, then we want to take profits when the RSI hits 50. In this case, the Dow came down and the RSI hit 50. The Dow Jones Industrial Average was able to accomplish a nice turn back to the downside. Again, we can use also technical analysis, trend lines, Fibonacci, etc., to approximate where the next support or resistance might be. However, I do not always like to wait for the market to come, or the RSI, I should say, to come all the way back down to 30, because we don't know necessarily if that's going to happen. Now, sometimes, and you'll notice, sometimes the RSI crosses above 70. Let me zoom out on this daily chart. Then we're going to get to the pound dollar, I promise. Sometimes the RSI crosses above 70, as we've seen in the past. This was almost 70. That's 68. The previous high was 69.98. That's about close enough in my book. Yet the market continues to make higher highs. Why is it that sometimes the RSI crosses above and back below 70 and the market comes down, and the reversal trade would have been a good idea? And why is it sometimes, take a look at this situation, where the RSI crosses well above 70, we hit levels of 77, we draw a vertical line to mark off exactly when that took place, and we see here that the markets, whoops, I erased the RSI, putting it back, there we go. Okay, so sometimes the market makes a high, the RSI crosses above 70, we say to ourselves, hey, this is a good spot to sell short. Let me mark a horizontal line where I would have wanted to sell short. Well, we would have eventually been stopped out without any kind of significant pullback. Why is it that sometimes the RSI gives us a valid signal and sometimes it doesn't? Well, sometimes we're in a trending market condition. We can see a trending market condition because the market just continues to make higher highs or lower lows, and sometimes we've reached that critical top. How can we tell? Well, we can't really tell for sure all the time. However, one general rule of thumb that I think should be used hand in hand with the RSI, and we already mentioned it, look for the market not to make new significant highs. Therefore, take a look at when the RSI crossed and back below, above and back below 70. Take a look at the highest high the market was able to achieve. Remember, we want to place our protective stops above those highs. In this case, we would have been stopped out, but it's good we would have been stopped out. The bottom horizontal line I drew was the highest high the Dow hit when the RSI was above 70. Okay, that's fine. We choose to sell short, the market goes down, but then the market goes up. Well, our protective stops are placed above the high. I just placed a little bit above just to sort of illustrate, where we might have placed protective stops. We want to get out of the trade if the market makes a new high while the RSI makes a new high, or when the market starts to break out. And that is the real reason why we want to get out if the market makes new highs. Because the RSI very simply tells us as it goes above 70, the market's very, very strong. And as we get closer to 80 and 90, the probability of reversal certainly increases in our favor. And therefore, it's apropos, it's in our best interest to sell short. But during very trending markets, which the Dow Jones Industrial Average certainly was from March of last year until, just a few months ago, we want to get out of the trade if it's going to continue to go up. Now, there are other factors that we can use, such as take a look at the time of the day if we're looking at shorter-term charts. On longer-term daily charts, take a look at the time of the year. Markets tend to become volatile during active periods of time. Earnings season, April, July, October, and January, April, July, and October. Now, in this particular case, the market certainly broke to a new high during August, and that's not very, very common. Nevertheless, the market did break to a new high, and we want to get out if the market does break to a new high, especially if the RSI confirms that it's going back above 70, which it essentially did, or right at 70, while it made new high. Now, the opposite also holds true for buy signals. That was a sell signal that we took a look at the top of the Dow Jones Industrial Average. Then we take a look at the bottom. The RSI hit a low of 29.95. Now, if the RSI comes down to 31, I'll still probably take the trade, but the more lax we are with our rules, the more greater amount of trades, and hopefully not, but the probability is the greater amount of losing trades that we might find. So, I may take an RSI trade at 31 as opposed to 30, but I don't want to take RSI trades at 35 or 40 because that gets too close to the 50 level, and that certainly does not bode well in our favor. Now, with that said, we take a look at the RSI at the lowest low, and that appears to be over here. We can notice the market actually made a little bit of a lower low. 99.94 was touched on January 29th, and the long candlestick wick actually came down to 97.87. Now, it does seem like a lot, but this is a futures chart. I don't believe the Dow Jones Industrial Average cash market came down that low. Also, we certainly can't expect the market to make a slightly higher high or lower low during these swing periods of time. But notice, as the market made a slightly new low with a long candlestick wick, the RSI made a higher low. And that divergence again was a signal that the market had a better chance to reverse. RSI hit lows at 29.95, and the second low was at 31.80. Only a few points difference, but every point means something. Now, those are reversal trades. Again, sell short when the RSI crosses above and back below 70. Go long or buy when the RSI crosses below and back above 30. Placing our protective stops above the highest high, or if we're buying, below the lowest low, and always give yourself a good amount of breathing room. And it's best idea to take profits according to our general rules of technical analysis, trend lines, Fibonacci, etc. Because a general rule of thumb, the 50 level on the RSI is a nice spot to take profits because the highest probability is the market will touch that 50 level again. Now, those are reversal trades. We can also look for trending market conditions. Trending market conditions is when a market makes a higher high or a lower low. This has been the case over the past year in terms of the Dow Jones Industrial Average, and was in terms of the pound dollar, which we'll take a look at in a moment. How do we look for breakout trades? Well, in the case, the most obvious case over here was when the RSI crossed above 70. What I want to do, if I see the market's going to make a higher high, I want to take a look at the last highest high the market was able to achieve. For example, take a look at the highest high, 88.77 were the highs June 11, 2009 on the Dow Jones Industrial Average. Now remember, if we're looking for a reversal trade, we want to sell short when the RSI crosses back below 70 after being above 70, as long as the market does not make a new high. However, if we think the market's going to make a new high, if we had the foresight to think, hey, the Dow Jones Industrial Average, I think it's going to go up a lot more, we want to look for the opposite situation. We want to look for the RSI to cross above 70 while the market also makes a new high. And that is important. So again, 88.77, I think is what I said. Yeah, 88.77 was the highest high, with just assigned 88.70, 88.80, close enough, 3 points off. Now, the market, and what I mean by market is I want to wait for a closing candlestick. And a lot of times you'll see exactly what happened here. The first candlestick to really close at a new high. This was July 23rd. Hey, middle of July. That's right in the middle of earnings season. That's considered to be an active period of time. January, April, July, and October are considered the most active periods of time. U.S. stocks report their earnings, and we expect the market to develop a greater amount of volatility. And that's exactly what happened. Dow Jones Industrial Average makes a new high. RSI crosses above 70. We would look to buy a breakout. This Dow Jones Industrial Average break on July 23rd occurred right around 9,000. We can see what happened. The Dow Jones Industrial Average, it went up a lot more. Now, as far as taking profits, it's a little bit of a different situation. With some traders will say, hey, I'm going to take profits based on a reversal, meaning that I'm going to wait for the RSI to cross back below 70. It eventually did. When it did, We can see the Dow Jones Industrial Average broke out from 9,000 to about 9,300. Some traders will hold on to the trade, watching the trend lines to see how that works. We would not have known this trend line existed. Some traders use Fibonacci projection levels. That will change from trader to trader. However, the buy breakout strategy occurs again when the market and the RSI both make both make new highs, hopefully on the same candlestick, or at least on a very, very close period of time. Selling short on a breakdown, we look for a similar situation. We look for the market to break to a new low. This was the lowest low that the market was able to achieve. Take a look at the low candle for 10,111 on November 27th. And then the market made a new low. And guess what? The RSI just barely crossed back below 70. Actually, to be completely accurate, that's when the RSI crossed back below 70. And as far as placing protective stops, well, if we think we're breaking down, we want to place a protective stop at the last swing high, meaning the last highest high the market was able to achieve before the breakdown. Or in case of the breakout, well, we'd have to place a protective stop below the last low. However, breakout trades, sometimes we have to use kind of wide stops. We have to account for a little bit of volatility. Those are the two basic situations that we use the RSI for. We're going to take a look at some foreign exchange charts. Again, if there's any particular chart that you want to see, let me know. And we're going to try to identify, going back, what would have been the appropriate trades. Now, let's take a look. We're looking at a pound-dollar daily chart. Going back to, let's take the RSI at the lowest low that we were able to see over here. The RSI was on 30.87, 30.66 I see is the lowest low, just about 30. Now, if you're really picking, you really want to, find the best trades, you want to wait for the RSI to officially cross below 30 or officially cross above 70. However, if the RSI gets around 30 or 31, 1 or 2 points difference, that won't bother me too much. Now, RSI crosses a straw line here at the lowest point, hits around 30. And at the same period of time, mark off the lowest low that the market was able to achieve. And the lowest low in the pound dollar I see, I'll give you the date, 157.68 on September 28th. September 28th of 2009, the pound dollar hit the lowest low. Well, if we would have purchased the pound dollar, gone long the pound dollar, hopefully as close as possible to the low, 157.68, the market made a little bit of a new low, 157.05. About 63 pips difference. On a daily chart, we certainly have to expect a little bit of volatility now for that to occur. Notice that the market did make a little bit of a new low. However, the RSI made a higher low. New low, a little bit of a lower low in the pound dollar, a little bit of a higher low in the RSI. That disagreement or divergence was our signal. It's the extra signal that tells us, hey, there's probably a better probability that the market will reverse back to the upside. If the pound dollar had made a new low on October 13th and the RSI had been below 30 and below the previous lows that is established, well, I have my protective stops in there, absolutely. However, I probably would have wanted to get out of the trade anyway. But the divergence, the disagreement between the lower low and the higher low gave us an extra piece of confirmation. Not a bad spot to look to go along the pound dollar. Well, the pound dollar eventually ended up going up. The RSI crossed back into the 50 level. Short-term traders take profits at the 50. If you really believe in the trade, maybe we hold out for a little bit of greater profit. Then the RSI hit a level of 68, which shows a little bit of higher level than that, but about 68. When that occurred, draw a line here. The pound dollar hit highs of 166.37. The day after 166.92, we'll draw a line at the highest high that the market was able to achieve when the RSI was as close as possible, 166.92. Now again, the RSI did not officially go up 70, so it really is up to you whether to take the trade or not. Some traders will take it. Some traders will say, I want to wait for that really true signal. And we can see from the highest high of 166.92, the pound dollar ended up hitting highs of 168.77. This is what happens when we try to take trades maybe a little bit before we should. RSI did not hit 70. It hit 68. It showed us the market still had more room to go. Eventually, that reversal did work out. However, it would have required a greater amount of protective stop orders because, again, we're taking the RSI trade at 68 and not above 70, and that's not very good. The next, I see a question over here. What is your explanation that after all invented new high significant indicators, these kind of indicators like RSI, MACD, and other always survive the evolutionary process that there's still no sign that they won't fail? It's a great point, Philip X. It's, these indicators, I like them, but, I think that we have to, as traders, I think we sort of have to accept them for what they are. I mean, after all, you take a look at the RSI or the MACD or the slow stochastics, any one of these oscillators. Oscillator measures the market on an up versus down scale. They're somewhat two-dimensional. The RSI, what does it measure? It measures price over time. It measures the relative strength or the relative price over the previous 14 periods. I think it would be very unrealistic to assume that, an indicator as simple as the RSI, I mean, it really is kind of simple, that if you actually look at the math of how it works, that something so simple would be able to quantify something so complex and sometimes so random on a short-term basis as financial markets. I mean, if the RSI found accurate trade signals 80-90% of the time, what would happen? I would use it, you would use it, everyone would use it, and eventually I think the market would adjust to that. If every single one of us bought the pound dollar down here at 157.60 and sold short up here at 167, well, eventually, if you're going to sell short at 167, maybe I'm going to sell short at 166.80. And if you're going to buy at 157.60, I'm going to buy a little bit higher, 157.80. And then my buy orders are going to push the market up a little bit, and my sell orders are going to push the market down a little bit, and then the RSI might not get there. Why did this reversal and this, there's a term, I can't recall what the term is, this exuberance, this point of exuberance, or this actual, the reversal point I'm trying to say, why did this take place? Because the majority of the market, meaning the majority of the pound dollar traders, were probably short the pound dollar, selling short, 70% were short, 80% were short, eventually maybe 95% of the market was short. But if you think of it, think of all the traders in the world that trade the pound dollar. Let's say that we have 100 traders sitting in one classroom, and that represents the entire world in terms of the market. Well, if 95 out of 100 traders are shorts, what does that mean? As soon as the market goes up, eventually 95 traders start losing money and they start buying. And that 5%, or the 5 traders that are long, that bought the market, they start making money, they have more margin, and then the ratio swings from 95% to 95 to 5 to 90 to 10, and then you have a fast reversal. That's why reversals really occur so quickly, because it's that change of hands. When all of a sudden all the shorts say, uh-oh, I'm losing money, let me get out of my trades, or we get margin calls, or our stop orders are hit, and all those shorts become buyers, and all those buyers become bigger buyers, and then the market turns. So yeah, I mean, to use the RSI, the MACD on its own, it will find losing trades. It's, very simple as that. However, the most helpful way that I've found personally to use the RSI or the MACD is to use it in conjunction with other general rules of thumb, such as if I'm going to buy the RSI when it crosses below and above 7, or below and back above 30, and sell short when it crosses above and back below 70, my own rule or filter that I want to use is to also make sure the market does not make a new high. And I want to look for the cases of divergence. Take a look at the RSI, makes a high, market makes a higher high, the RSI makes a lower high. And that was a nice divergence signal, not very clear in this case, but, actually the buy signal that occurred going back to September of last year, that was a nice case. RSI hits a low of 30 and then hits a higher low of 35. The market hits a low and then a lower low. Well, if we're program traders, then we would be able to program a strategy that would look for that. But just using the RSI on its own, if we did not know to look for this divergence or this disagreement, we would probably look to sell short. Or if we didn't know that the RSI existed and we saw the market make a new low, well, then I would also look to sell short. And again, I mentioned this in the past, note the time of day, note the time of year. Note that the market tends to become active and has the best probability to make new highs or make new lows during the first 2 or 3 hours of every trading session. You'll notice that the European session is probably most active between 3 to 5 a.m. Eastern. U.S. trading session, most active, 8 to 11 a.m. Eastern. That's because that's when all the big economic numbers are usually released. Markets are most active during this corporate earnings season. January, April, July, and October. That's when the markets tend to be most active. So if it's 6:30 in the morning a.m., 6:30 a.m. Eastern, in the middle of August, a quiet time of the day, a quiet time of the year, I am not really going to expect the market to make a new high and break out or make a new low and break down. So we start adding in our own filters, intelligently trying to improve our probabilities of being right, of guessing right, then the RSI, I think, becomes a lot more helpful. Another question. I don't know if it was after the players get changed to forward speed term. Possibly. I don't know. At any rate, I want to take a look at some other charts as well. But really quickly, before we get to the chart, the last trade that the RSI really gave us was when we crossed below and back above 30. Most recently, February 8th of this year, not too long ago, the RSI crossed back below and back above 30. The market, the pound dollar specifically, hit a low 155.32 and then rallied to the upside. And you'll notice if we place our stops below the lows, well, the market made a new low. The RSI hanging very close to the 30 level did not officially cross back below 30. However, we used a certain amount of protective stop. So if this occurs where the market really breaks below the lows, our protective stop tells us, hey, we got to get out of the market. It's time to get out of the market. But I'll tell you something else. It gives us an extra hint. Because we hit a critical low, and when the RSI crosses below and back above 30, mark down a horizontal line on the chart. It marks an important period of time. It marks an important period of time when the market, the pound dollar, has hit a very critical low. If the pound dollar subsequently makes lower lows, forget any trades that I may take. This tells me, I'm going to write down on a piece of paper, pound dollar, I think we're going lower. Because we drew a line in the sand, we said 155.36 roughly, or 32. That was the lowest low when the RSI crossed below 30. And now look at us. We're 2, 3, 5 candlesticks below that 155.32 low. We can't get back above. I think the pound dollar continues to go down for a lot of other reasons. I think that the pound may go down the way the euro has been lately, fundamentally. But, just based on the RSI, this is giving me a hint. We drew a line in the sand when the RSI crossed below 30 and back above 30. And now the pound dollar cannot even get back above that level on a price basis. Well, then, I gotta get out. Next chart on request was the euro dollar, and I see another question here. What is the lowest time frame to work well for the RSI? It's a great question, Boyke. My favorite time frame, as I mentioned before, is daily charts. I think it represents a nice compromise between short-term trading action, long-term trend, etc. However, you will see here with daily charts, well, we see breakdowns that occur February 3rd, and then the last one before that was December 21st. So, if we don't want to wait a month and a half between trades, we can look for shorter time frames. The 4-hour chart is okay. And just to give you an idea, you should see a 4-hour chart, by the way. This is the euro dollar. The RSI gave us a signal on February 5th. Prior to that was January 29th. Prior to that was on January 20th. So we see about 5 or 10 trading days in between. If we go to a 1-hour chart, we can zoom out on the euro dollar, and we can see here where there was a signal on February 17th, and before that was February 12th. Everyone's different, but I'll tell you, less than a 1-hour chart, I think, I'm not saying the RSI can't be used effectively, but I think that it starts to lose its effectiveness and it's really not justified. In fact, ideally, my answer to your question, I would say daily charts and 4-hour charts. Sometimes a 1-hour chart as well. The reason being is because, let's take a look at a 15-minute chart. You may ask, well, why can't I use a 15-minute chart? Well, we'll see why. We see here, this is a euro-dollar 15-minute chart. And the RSI hit a really nice high, 80 all the way up here when the market hit a highest high, and it crossed back below 70, and that was our place to sell short. And the market ended up going down, and it gave us a nice buy signal. The RSI crossed below and back below 30. Let's take a line a little bit more accurately. Two reasons. Short-term charts, like the euro-dollar 15-minute chart we're looking at now, the foreign exchange market, it's a trendy market. The currencies move for reasons. There are trillions and trillions of dollars that flow through the 8 largest currencies that we trade: the euro, pound, Swissy, Aussie, Kiwi, CAD, dollar, yen. When these currencies start to move, anybody notice the euro dollar go down or the euro go down against everything over the past couple of weeks? There's a reason. Now, fundamental analysts, they'll say, well, there's a lot of problems in Greece, and that certainly isn't helping. But, putting fundamental analysis aside, the euro dollar, by the way, is the most actively traded currency pair. So I believe I had heard at one point about 50% of foreign exchange capital, 50% of the money in the FX market is euro dollar. I don't know if that's still true or not, but it's a lot. If the euro dollar is moving down, let's go back to a daily chart for a moment. This euro dollar, we hit highs in middle of January of at 145.79. We're at 135.54. Remember, euro dollar historically is not a very active currency pair. That's 1,000 pips in about a month. For the euro dollar, imagine how many trillions of dollars selling euro and buying dollars, or selling euro and buying yen, or selling euro and buying anything. How many trillions of dollars was necessary to move the euro dollar 1,000 pips in about a month and a half? There's a reason why that's occurring. Now, a penny stock can go from 20 cents a share to 25 cents a share with one big buyer, and it might not be fundamentally motivated at all. However, the foreign exchange market, especially the active currency pairs that we trade, there is a reason why these currencies move. I'll leave it up to the fundamental analysts to try to, discover why. I kind of consider myself 50% fundamental, 50% technical. A lot of fundamental analysts will talk about the European Central Bank making a statement recently saying they don't think, if I remember the article correctly, they do not expect that they'll raise rates anytime soon, and probably not until the end of maybe 2010. Well, if I know the European Central Bank is probably not going to raise rates until 2010, meanwhile, remember last week, what did the Federal Reserve do? They raised the discount rate, not the interest rate, but the discount rate, the rate that the banks lend between each other. And they raised that rate, and then the Fed futures had indicated that there was now a 25% chance that the Federal Reserve will raise interest rates in the U.S. between now and the end of the year. Well, if I tell you there's a 25% chance that the U.S. dollar will have higher rates, probably almost 0% chance that the European Central Bank will raise rates, if I was a betting man, I would sell short the euro dollar. Well, over the past 6 weeks or so, if I had sold short the euro dollar based on that piece of news, I would not have been alone. So there's a reason. So to answer your question, and I promise there's a point here, but the short-term chart, I don't think they do justice to what is really the advantage in trading foreign exchange between in the sense that these long-term trends, they occur for a reason. I like to stick my capital on the same side of the long-term trends. It's like trying to sail from the Atlantic Ocean to the Pacific Ocean. We know we have the strongest gust of wind in our sails going in our favor. We have a very good probability of just letting the trend carry us forward. So the short-term trend, it's too, it's neither here nor there, meaning it'll go down a lot, then up a lot, down a lot, and up a lot, and it tends to shake us out of trade. More so than that, we always want to look for that risk to reward ratio in our trades, meaning if I'm going to risk 100 pips in the trade, then I want to be able to make at least 300, 3-to-1 risk reward ratio. But in short-term trades, we might have to use a 50 pip stop and try to make 50 pips in target, in profit. Well, that's a 1-to-1 risk reward ratio. So I don't like it as much. So going back to answer your question, I see there's other questions here as well. I like daily chart and 4-hour chart. However, I guess you could use a 1-hour chart time frame. But really, try to use the long-term charts. Try to find the daily charts. I think at the end of the day, you're going to find yourself a lot more comfortable and a lot happier with the trade. Now, let me look at some of these other questions that folks have typed in. Is the RSI a leading or lagging indicator? I would say that the RSI, like all oscillators, like really all technical indicators, is a lagging indicator because it's measuring previous price over time. So what's a leading indicator? A leading indicator, if I understand this correctly, a leading indicator is something we talk about in fundamental analysis, meaning what non-farm payroll is going to be the first Friday of next month. I don't know. But some fundamental analysts, they will look at the ADP employment numbers, which are released more frequently. They will look at the initial jobless claims in the U.S., which are released on a weekly basis. So some fundamental analysts will say, hey, initial jobless claims were this, and we were expecting that, and next week they were this, and we're expecting that. And we'll take that all information together, throw it into their fundamental calculator, and say, I predict the non-farm payrolls will be this. And, you know, the consumer price index and the producer price index, these inflationary numbers, they're released once a month. So how do these analysts sort of try to guess to see where the CPI or PPI may be? They're going to look for the shorter term inflationary numbers. Maybe they're going to go to the stores, to the Walmart stores, and count how many people are staying online. Say, well, there's a lot more people than we expected online, and that would be a leading indicator because it's leading us to the next big number, if I understand the term correctly. Question is, a new carry trade in the euro dollar coming? It's tempting. It's now the carry trade again, for those of you not aware, it's the difference in interest rates between the two currencies. Where are euro rates right now? I believe they're 1%, if I'm not mistaken. US rates are essentially 0 to 0.25%. What's the difference between the two? Around 1%, a little bit less in favor of the euro dollar. Yeah. So far there is a positive carry trade, meaning if you buy the euro dollar, you're going to collect a little bit of extra interest. You always collect the interest on the currency that you buy. If you buy the euro dollar, you buy the first currency in the pair. Selling short the dollar, you're liable for the interest in the second half. But I would say it doesn't have a huge effect because the difference in rates is not that great. However, if you take a look at the Aussie yen a couple of years ago, when the Aussie rates were 5, 6, 7%, and yen rates were basically 0, when you start to see a difference in interest rates, 2, 3, 4%, the greater difference in rates between the two currencies, that indicates that we could sort of guess that carry trade is going to have a greater effect. I predict, if I had to close my eyes and predict what's going to happen, I think the euro dollar carry trade will probably narrow, meaning I think the Federal Reserve is more likely to raise rates sooner than the European Central Bank. Who's going to win in the end? I don't know. There's a lot on the table as far as, does the European Union come out of this mess anytime soon? News out of Spain and Portugal and especially Greece has certainly not been that good lately, and the European Central Bank does not want to raise rates, not with that going on. Now, just check the RSI as a leading indicator. It is. Well, going back to pound dollar, RSI crossed above, but that price actually stays below the line, meaning the RSI giving indication price will cross back soon. Let's go back to the pound dollar. If there's other currency pairs, by the way, please don't hesitate to let me know. My interpretation and the beauty of technical analysis is the RSI, by the way, a leading indicator? I could be wrong on that. I reserve the right to be wrong. I always consider leading indicators to be fundamental indicators in the sense that they sort of predict what's going to happen in the future. Lagging indicators, how I've always perceived them, is in the case of technical indicators, because it's not measuring future price action, it's measuring previous price action. But then again, I could be wrong too. My interpretation of the pound dollar in terms of the RSI, and then I'll get to the dollar Swiss, is that the RSI crossed below and back below 30. When that occurred, the pound dollar hit a lowest low of 155.30. Well, the buy signal occurred, and let's pretend that, let's roll back the clock and pretend that today was February 8th when this crossover occurred, February 8th, February 9th. Well, let's say you and I and everyone bought the pound dollar based on this crossover. What does it look like an intelligent trade at the time? Fantastic. Well, we all buy the pound dollar. But what happens at the moment, and I'll tell you when, it was February 18th, when the pound dollar crossed below that low and made new lows, and especially the 90s, we went down to 153.44, almost 100 pips lower, probably most of us would have been stopped out. What does that mean? Well, let's say, there's 43 people in the room, including me, so let's say 22 of us were long the pound dollar, and at 155.36 or higher, and 21 of us were sold short the pound dollar. We were short the pound dollar at 155.36 or higher. What happens when the pound dollar makes new lows, and especially down 100 pips? That means all those buyers out there, let's say I bought it, well, I probably would have been stopped out, or hopefully not, but maybe a margin call. Either way, I would have been out of the trade. I'm selling, if I bought the pound dollar, I got to sell it to close the trade, or if I get a margin call, my broker sells it automatically, and that adds selling pressure. Well, everyone who sold short the pound dollar, let's say all of you sold short the pound dollar at 162, and all of a sudden we see a new low, 153.44. That's a nice profit, and you now have more margin. You now have less reason to be worried, and you probably maybe you want to sell a little bit more. Just, hey, money's working, and so let's try to maybe sell a bit more. But even if you didn't, you're further away from your stop order. It'd be less reason to get out. After all, if the trade's working, if you made 100 pips, you're probably thinking, I'm thinking, hey, can I make 150? Or can I make 200? If the trade's working, let it work. So all of us who bought it, I'm losing money. All of us who sold short, we're happy and we're making money. And now that the pound dollar and that old saying or the old adage in technical analysis, former support becomes new resistance, and former resistance becomes new support. If this is all our floor, well, now we fell through our floor. Our former floor is now our new ceiling, and this tells me the RSI crossed below and back above 30, and yet we still have failed to reverse back above 155.36. That tells me there's something going on, and the pound dollar, I think, is going to go lower. Fundamentally, I could also make a very good argument, but we're not talking about fundamental analysis today. In terms of technical analysis, because we made a new low, it tells me all the buyers are unhappy, and most of the sellers are probably very happy, and that increases our chances of going down. Now, let us go to the dollar Swissy chart, and I'll see some more of these questions as well. Now, in your opinion, how accurate does RSI compare with stochastics? Slow stochastics, well, there are two stochastics. I assume slow stochastics I like better. Fast stochastics are just a little bit too fast for me. So I'll show you slow stochastic indicator. Excuse me. Now, the indicator you should see on the bottom of the RSI is the slow stochastic indicator. It works in a similar way to the RSI. These are essentially, there's actually a big difference in terms of the math, but in terms of using the indicator, it's not that big a deal. RSI, remember, we use levels of 30 and 70. Slow stochastics, 20 and 80. RSI, we look for a sell trade when we cross above and back below 70, and a buy trade when we cross below and back above 30. Slow stochastics, what I like to do is wait for these two lines. One is the stochastic line, one is the indicator line. It doesn't really matter because it's very easy to figure out how to use them. I'll show you how. When the two lines cross above, one will always be on top of the other. The sell signal occurs when the one line crosses above, or we could say one line crosses below the other when both lines are above 80. Again, both lines have to be above 80, then wait for the crossover. The buy signal occurs when both lines are below 20 and a crossover. Essentially, look for the crossover above 80 or below 70. Now, you'll notice something, and I'll mark off the slow stochastic trade signals that occurred. And I'm really glad you mentioned this because it helps prove a very, very important point. I'm marking off all the times that the slow stochastic indicator, this is a daily chart dollar Swissy, by the way, that it crossed, that wasn't good, but that the slow stochastics gave us a trade signal. Now, this is going back to October 25th of 2009, dollar Swissy daily charts. Now, let's look at the RSI. How many buy and sell signals occurred? Just crossing above and back below 70. This little exercise is sometimes very, very helpful. You compare different indicators. I'll even say maybe this one. Actually, was that above 70? It was 69, so I'm going to say no. That was above 70 though, just right about here. Okay. How many slow stochastic trade signals did they give us? 1, 2, 3, 4, 5, 6. 6 trade signals in the past 4 months. Slow stochastics. RSI, how many trade signals? 1, 2, 3. Slow stochastic indicator generated twice as many trade signals as the RSI. And as far as I'm concerned, twice as much probability that we could have had losing trades. I always like to assume the worst and move error towards the side of caution. Because if for no other reason, we do not have an unlimited amount of trading capital. Unless we're trading demo accounts in that case, I certainly encourage you to practice as much as you can. Whoops, I even missed a trade signal on the slow stochastics. Going back at 7 slow stochastics indicator versus 3 RSI. Well, I have a limited amount of trading capital in my account, and I want to save that trading capital to the highest probability trades. I want to take the fewest amount of trades as possible. In the automatic trading systems that I've worked with in the past, in my own experience, I've noticed that the best performing systems, automatic systems, are in the market the least amount of time. We should not, if you find yourself in a trade 80% of the time or 90% of the time, or that, you find yourself, I'm long the euro dollar and I sell it, and now I'm short the pound yen, and then I covered, and I'm long the CAD yen, got stopped out. If you find yourself trade to trade to trade, that's not good. Now, if we're a long-term trader, I might buy the euro dollar and hold on to it for 2 months, and that's okay if we're using long-term charts. But after the euro dollar trade's closed, you might see yourself without any trades for a couple weeks, maybe even a couple months. We should not be in the market all the time. The slow stochastics indicator is going to have us in the market a greater amount of time. That's why I prefer the RSI. The difference in the math, the way it works, you'll see that the RSI is just a bit, the RSI is a bit more selective. And you made a great point, Ralph. I'm comparing an RSI, exactly right, 14 periods back with the slow stochastics on a 5 period. Those are the standard settings, 5, 3, and 3. Some traders use 5, 5, 3. You're right. I always use the standard settings. Those are the standard settings, and I like to believe whoever made up these indicators is smarter than I am. So I use the standard settings. You can try the 14 period. After all, we have a few seconds left. I can do that. We can see 5, 3, 3. Well, let's change all these to 14. But then again, if we change all these to 14, we're not using the slow stochastic indicator as it was intended. After all, if I'm going to use 14, 14, 14, I might as well use the RSI. There is a rationale. There is a reason why the slow stochastics is set to 5, 3, 3, meaning the percent K is 5, percent D is 3, and the slowing factor as well as 3. There is a reason, but whatever the reason is, whatever the math, I don't know what the reason is, but there is a reason why these charts use these standard settings, and they're pretty much the same on all different chart packages. It's going to find a greater amount of trades. Now, maybe it's better suited for other markets. Maybe that, you can use the slow stochastics on a daily chart, but it means you're going to want to get in and out of trade very, very quickly. I mean, after all, and I'll tell you something else. Let's zoom out on the dollar Swissy daily chart. Take a look at the, let's find a good signal to use. Oh, excellent over here. Take a look at the sell signal the RSI gave us when we hit highs near 105. This was late December of last year. From 105, we eventually went down to lows around 101. 300-400 pip move. Well, the slow stochastic indicator, it also gave us a trade, but maybe we would have closed that trade within 1 or 2 candlesticks. The RSI, and this is my personal preference, I'd rather take a fewer amount of trades and hopefully make a bigger amount of money on each trade. Why do I want to pay the spread or pay commission a greater amount of times and take more risk each time? I'd rather take a fewer amount of trades and hold them for a greater period of time, hopefully for a bigger amount of profit. Shorter term traders, you may turn towards the slow stochastics. And someone explained this to me once. What's better, the RSI, slow stochastics, MACD? It really is very much personal preference. It's just the way our minds understand and compute the data. For some reason, RSI seems to make a lot of sense to me. Slow stochastics, not so much. You may be on the other side of the coin, but that again is the case. With that said, what I would certainly recommend is take the slow stochastics, open up a demo account, one of these brokers. Trade only slow stochastics. I know it's kind of tedious, but it really is worth it. Trade the slow stochastics for 30 days in the demo account. Open up another demo account at the same period of time and trade only RSI signals, and maybe the MACD or something else. At the end of the 30 days, look at the trading results. I think that you'll find the results very interesting, and maybe it'll help you find what is the indicator that best suits your needs and your trading personality. Isn't studying stochastics with fewer signals better to get stronger probability of signals and less time in the market? Yeah, it's correct, but you're correct in saying that you're going to get a fewer amount of signals. However, I tend to believe that the slow stochastics are set to 533 for a specific reason. I honestly don't know what that reason is, but I tend, again, this is just me, I don't like to change the settings on the indicators because I think that maybe it takes away from some of the value that the indicator offers. And also, for another reason, I like to see the indications, the sell and buy signals that other traders see. Anticipate of, other times that traders may want to get in or want to get out. There's a great question. What other indicator use combination of RSI? It's an excellent question. If you're using an oscillator like the RSI, slow stochastics, MACD, or even the Bollinger Bands, only use one. Don't need to use RSI and slow stochastics. However, take one oscillator, RSI or slow stochastics or MACD, and then use it with trend lines and Fibonacci. I think those three together can be used very, very effectively. I always use trend lines. I always use Fibonacci plus one indicator. In this case, RSI, maybe slow stochastics for you. What method to use for market volume? In the foreign exchange market, I really don't pay attention to volume because some volume is not very, very accurate in the sense that we can't really, know if one broker is reporting the volume for their book. If we trade stocks on New York Stock Exchange, we know the volume represents all the stocks traded on the New York Stock Exchange. But if I were trading stocks, to answer your question, I would just use a simple volume and look for breakouts under periods of high volume. But you can, in the foreign exchange market, you can substitute that for active periods of time. You can induce that if you trade markets during active periods of time, the first 2 or 3 hours of every trading session, you can infer, I should say, that there'll be greater amounts of volume. Better trade FX futures, it's up to you. I think you get better leverage in FX, in the cash market, and futures, like options, tend to be a little bit more expensive on a commissions basis, and also maybe a little bit more expensive to buy or sell if the market's moving in the direction that we want to trade. I am out of time, unfortunately. Wow, great questions. I wish I had more time. However, if you want to contact me directly, please don't hesitate. www.forexlounge.com is my website. Please feel free to contact me there. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see their calendar because they'll be back on next month with much, much more. Again, we thank you all very much for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back.